Welcome to Safe Option Strategies presentation of Adjusting Straddles and Strangles. This class is a production of Safe Option Strategies and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for education purposes only. Safe Option Strategies does not make any recommendations to buy or sell stocks or options. Trading stocks and options comes with risk, and you are solely responsible for any losses you may incur as a result of trading. All right, so let's review the straddle strangle. Now, if you remember from the previous class, whether you watched it live, whether you're going through the recordings in order, from the previous class, you probably remember, technically speaking, and it's important to know this because this is what you're going to find oftentimes on your broker's website. But technically speaking, the straddle strangle is a combination trade. By definition, a spread trade uses a short and a long option. The straddle or strangle uses no short options when it starts out. It is a long call and a long put placed with the same expiration date, same strike prices for a straddle, different strike prices for a strangle. It doesn't have to be more complicated than that. Typically, it's a money out trade, meaning when we close it, we're going to completely sell to close the trade. The options are typically placed at or just out of the money. Oftentimes when you're in a straddle, one of your two options is going to be just in the money. Not very often when you're opening this trade is the price of a stock right on the strike price of a particular option, such that you could open up as a straddle and have both options right at the money instead of one of them being in and one being a little bit out. We typically go 90 days or more. Now, there's exceptions to this. I told you in the previous class, we're not going to talk a lot about those exceptions until we get into our out-of-the-box debit spreads class, and that's down the road a little ways. Typically, we want to be 90 days out in expiration or very close to it or farther than that. You know, an 85-day trade that all the technical analysis we do and all of our study of the trade, if it all looks really good, but it happens to be 85 days out instead of 90, we shouldn't walk away from the trade for that reason alone. But our preference is going to be 90 days out or farther. Maximum risk is whatever we pay to be in the long call plus the long put. That is also our what we refer to as our cost basis or our net debit. And our maximum reward is theoretically unlimited to the bullish side. To the bearish side, whatever the strike price is of our long put minus what we paid to be in the trade, that is the maximum profit we could make to the bearish side. Good target return is oftentimes 20 to 30%. We want to be in the trade for less than 6 to 8 weeks, but like with a lot of trades, if we can get a realistic or a nice profit, and that might be 10, 12, 15%, if we can do that inside of a couple weeks, that would be a good thing to do. One thing that I mentioned in the previous class, if we are 2 weeks into the trade or less, or we are faced with the possibility of having to adjust the trade, and we can get out of that trade with 10% or more profit, we should exit the trade. All right, there's our review. Now, if we get a strong enough movement to the bullish side, or if we get a strong enough movement to the bearish side, we may not need to make an adjustment. That does not mean that we couldn't make an adjustment that would help the trade along, sort of give it an assist to get to its profitability. And we'll talk about that in a minute, but we're going to kind of save that for towards the latter part of the class. But what we don't want to have happen on a straddle or strangle trade is to go into a stagnant trend. Now, a stagnant trend does not always have to be a perfectly flat line. A stagnant trend could be a slightly bearish or a slightly bullish trend that is just not moving very strong, and we would therefore refer to it as a somewhat stagnant to slightly bullish or a stagnant to slightly bearish trend. That may be all that's needed for a straddle or strangle trade to be considered going against us or not moving in our direction. So we open the trade. We are hoping for some strong movement up or some strong movement down. And as we talked about in the previous class, we want that strong movement up or that strong movement down to be far enough past the strike price of our long call or far enough past past the strike price of our long put to get us to a point where we can be profitable in the trade. But after we open the trade, we're expecting that strong movement, and then we get into a somewhat stagnant trend. The reason I have this line drawn at a little bit of a downward angle is because more often than not, that stagnant move has a little bit of a bearish or a little bit of a bullish angle to it. Not always. Sometimes we get some strong levels of resistance, some strong levels of support, and that stock will just bounce in between, and there's no definitive bullish or bearish movement. It's dead flat. That happens sometimes. That's not as often the case as having stagnant to somewhat bullish or stagnant to somewhat bearish. One of the things we have to do in an adjustment, or one of the things that we try to do when we're adjusting a straddle or strangle, is choose a side. We've got to look at our long call and we've got to look at our long put, and we've got to say which one of these is our winning side, which one of these is our losing side. And once we pick a side, now there's several things that could go into choosing a side. Choosing a side might be choosing the one that looks like it's more profitable. Choosing a side might be the one that we feel more comfortable adjusting. Choosing a side might have to do with the overall movement and expectation and current feel of the market and what the markets are doing. There's a number of things that could go into choosing a side. Whichever side we choose, one of the adjustments we can make to a straddle or strangle is to sell to close the one that we don't choose. When I say choose, what we're really doing is choosing which option we're going to leave open, and then we're going to close the other option. Whichever side we choose to leave open, we're then going to add short options to that side at an earlier expiration date, and we may be at the same strike price, we may be at a higher strike price, we may be at a lower strike price. We're going to create some type of a calendar spread. Now, let me give you a hint on, and there will be exceptions to this, but let me give you a hint on choosing the direction. I want you to think back. I'm going to reference back to that calendar spread class a lot, and I'm going to reference back to adjusting the calendar spread. When we're choosing a direction for our straddle or strangle, think back to the calendar spread class. Do we ever want to open a bear call calendar or a bull put calendar? We oftentimes will adjust to a bear call calendar, or we will adjust to a bull put calendar, but that's not the trade we want to open. So if my stagnant movement is somewhat to the bearish side, I would rather sell my long call, get back whatever I can on that long call. Remember, our whole trade, both legs of the trade when we open it, are money out. Anything we sell this long call for, even if it's half of what we paid for it, is money in, and it will therefore lower our cost basis in the trade. And then if we add a short option, and we do so in the form, in this example, we're doing so in the form of a bear put calendar, that's the direction we want a calendar trade to go. Our preference on what direction we want a calendar trade to go would be either a bull call calendar or a bear put calendar. So if I have a stagnant trend, but it is slightly bearish, it's probably my calls that I'm going to close and my puts that I'm going to create some type of a calendar spread with, a horizontal or a diagonal calendar spread. And the reverse of it if my stagnant movement is slightly to the bullish side. So keep that in mind as a hint to what you may want to do. Now, the reason I say there are some exceptions to that, you might have a really, really strong level of support. Your stock might move slightly to the downside, but come up against a real strong level of support and start to turn a little bit. You might want to sell the long puts right then for profit. The put side will have profit, not the overall trade, but the put side, and then allow those long calls to go up a little bit and eventually turn them into a calendar or a bull call calendar and make the adjustment that way. So even if you start out a little bit to the bearish side, that does not automatically mean you're going to adjust by getting rid of your calls. You might wait a little bit for the puts to get profitable and then adjust the other direction. So there are different ways to do this. But as a general rule, you're going to leave the option open that is gaining value in the trade. Now, this is oftentimes what we have happen. We see all of the calculations are there to get into a straddle or strangle. On an earnings report, we get a really sharp move in one direction, but as people digest that news, suddenly we're moving back up the other direction, and then we're in kind of a stagnant trend. And maybe, and you know, we've talked about oftentimes, we get into that straddle or strangle maybe back here 3, 4, 5 weeks before an earnings report, maybe in some occasions as much as 6 weeks before the earnings report. And so we get our at-the-money call, we get our at-the-money put. Now this stock chart does not stretch out 90 days, but pretend for a moment that these are 90 days out. Okay, you got to use your imagination a little bit. So we get the earnings report, we get that strong movement down, but all of a sudden we're moving back up, and then we start to get this stagnant trend. So we've got to decide which one of these options are we going to adjust. Now, one of the challenging things with straddles and strangles, and it's a challenge. I've been doing straddles and strangles for almost 20 years. Before I really got into spread trading and really got an understanding of spread trading and collar trading and started to teach this, I knew the basics of a straddle or strangle, and I would do it on occasions. One of the most challenging things when it comes to adjusting straddles or strangles is knowing the timing for when to make an adjustment. I want you to write this down because I do not have this coming in as a bullet point. I did that specifically, I did that intentionally so that it would force you to make a mental note or to write it down. I'm a big believer that when you write something down, it reinforces it. So besides just hearing it, you're also reinforcing it by writing it down. The rule on timing of when we're going to make an adjustment, because we've got to figure out, how do we know when we're in these days right back here, how do we know that 7 weeks from now we're still going to be trading flat? We don't know that. When we're moving up a little bit right here and we're moving down a little bit right here, we're still probably uncertain. Are we into a stagnant trend, or is this going to be a continuation up here? Is this going to be a continuation down here? When we're looking at these trading days right here, we don't know. When we see this one big drop right here, we have no idea of knowing that that's going to bounce off of a level of support, go back up here, test resistance, and go back down here and create a stronger support level. We don't know. Here is the rule for the timing on making an adjustment to a straddle or strangle. And you remember in the previous class how I emphasized, and I did it again at the beginning of this class, where it relates to being out 90 days. There will be rare exceptions to that, but the reason we go out 90 days is because we've got to give ourselves a little bit of time. When we open that straddle or strangle, it would be absolutely fantastic if we opened it, they reported their earnings, and this downward movement just kept on taking them down, 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 and somewhere within 2 or 3 days after the earnings report, we could close our trade and make our target profit. That's what we want to happen. Or even if we get this downward movement and this reversal, we wait a few more days and this carries us up to a point where our trade is profitable. Either one of those scenarios would be a fantastic thing. We don't always get that. We hope for it. We've done our due diligence. We've planned. We've looked at a history of companies having big gaps up or big gaps down and then continued bullish or continued bearish movement. Then all of a sudden it doesn't go the way we want it to. So let me circle back around to the rule. You're waiting. You're just on the edge of your seat. Come on. What's the rule? What's the rule? Here's the rule. 2 weeks or 2 tests of support or resistance. And when I say 2 weeks, 2 weeks after the event. That is the longest you should wait to make an adjustment. Okay, that's the longest. Now, let me help maybe clarify this and make a little more sense of this. We set up our trade maybe back here, and we were awfully tempted to get out right here, but it didn't quite get us to profit. And then we moved up here, and it was kind of back to a stagnant thing, and we're just ahead of the earnings. And then wham, we get this big move down on the earnings. The very next day, we get the big move up. And this is when we start that clock, 2 weeks. Okay, if we go 2 full weeks out, and that puts us right about, there's 1 week out. Here's the end of this week, so there's 1 week out. There's the second week out. Right about here is 2 weeks past the event. Most of the time that event is going to be earnings. Not always, but most of the time. 2 weeks past the event, and we don't have a clear-cut direction, we need to pick a side and adjust. At this point in time right here, when all of our technical indicators were still a little bit to the bullish side, we would have probably chose to get rid of the long puts and gone with the long calls. We might have had to roll a short option right here when it started going up and out of this range a little bit, and maybe rolled it again going back here. That's probably what would have happened in this particular scenario. Or we've got, I would call this my first test of resistance, and these were kind of too close together. These two right here were sort of, this day right here and this day right here, those are kind of too close together for me to call them separate tests of resistance. I would probably consider this my second test of resistance, and this is certainly a strong test of support. Now, some people would look at all of this happening in approximately a week. That's a little more than a week's worth of trading, and some people would label that as one test of resistance or support, and this as the second test of resistance or support. You don't have to wait until here when you have had 2 separate tests of resistance. You don't have to wait until right here when you have had 2 separate tests of support. A combination of support or resistance, when you've seen 2 of those, and it might be both to the upside like we're looking at right here and right here, it might be one to the upside and one to the downside, but when you're 2 weeks past your event, or you have had 2 tests of support and or resistance. So it could be two times the support is tested, 2 times the resistance is tested, or one of each. You can't wait past that to make an adjustment to the trade. Otherwise, you're going to end up with a calendar spread that doesn't give you time to adjust. Now, that doesn't always mean that the adjustment is so crystal clear in your mind that you should choose the calls over the puts or the puts over the calls. The good news about adjusting from a straddle or a strangle into a calendar spread is that the calendar spread itself is one of the easiest trades to adjust. Go back and review that adjusting the calendar spread class. Whichever side we choose, bullish or bearish, we're going to take the option that we leave open and we're going to start shorting options against it. We may end up rolling those options when we get a little bit of a bullish movement. If that option expires, we may still not be to a break even or profit in our trade, and we might add a new short option and repeat the process until we get to that break even or profitable. When we have to adjust a trade, any trade, this doesn't just apply to straddles or strangles, when it is time to adjust a trade, our number one goal is to get back to break even if we can. And if we can't get back to break even, we try and narrow our loss as much as possible. And on a few occasions, it's absolutely okay to look for profit in that trade still. Okay, this time we've got a strangle instead of a straddle. We open the trade expecting a strong movement. Stock price sort of goes stagnant on us. This is an alternate adjustment. Generally speaking, we're going to pick a side. We don't have to. Here's the other beautiful thing about straddles and strangles. And this applies maybe a little bit more, only slightly, a little bit more to the strangle side of the trade, because we might have strike prices with a stock just choosing to stay right between those strike prices. That happens sometimes. The stock just decides that it's going to go into a perfectly flat pattern and stay in between the strike prices. There is no rule that says we cannot turn both sides of the trade into calendar spreads. Now, I'm going to caution you right here. If you choose to do this, you are going to separate and manage this as though it is a horizontal or a diagonal call calendar, and you are going to manage this as though it is a horizontal or diagonal put calendar, and you're going to manage these two as though you opened two completely separate trades. You're going to bifurcate these trades. Now, I learned that word years ago. I've got a good friend, an old college roommate of mine that's a lawyer, and he said sometimes when there's I don't know if it really applies to stocks or not, I like the word, in a trial, if you have multiple charges against a defendant, could be civil or criminal, the lawyers might choose to bifurcate and try those different charges as completely separate. Sometimes they're so closely related that a judge won't allow for that. Other times the judge will say, yeah, there's these crimes, even though they may have happened close together at the same time, there's enough distinction between these two things that they can be tried separately, and they refer to that as bifurcating. I don't know if that's a word that should only be used in the legal field, but I like the term. You're going to bifurcate your trade. You're going to now manage this as though it was never opened as part of a straddle or strangle. Now, this is the one exception to a lot of times when we're tracking and working with our cost basis. We talk about money in, money out. Let me tell you why I think it's important at this point in time to treat these as two separate trades. Let's back up a little bit. Let's say when we opened this trade, we paid $2.30 for our long calls, and let's say we paid $2.10 for our long puts. So our total cost in the trade is $4.40 per share. This is our net debit, this is our max risk, this is our cost basis. This is all money out, okay? 100% money out. We open the trade, it moves into a stagnant trend. We get to the point in time where we can add some short calls to our long calls, and let's say just hypothetically we take in 45 cents a share on these short calls. At this point in time, we're going to subtract this 45 cents from this $2.30. Okay, that's going to give us $1.85, right? We are now managing a call calendar or a bull call calendar with $1.85 cost basis. That is now the trade that we are managing right here. If when we add our short puts, hypothetically, let's say over here we only get 21 cents a share. $2.10 a share minus 21 cents a share is $1.89. We are now managing a put calendar spread with $1.89 per share cost basis. We don't try and subtract this amount from here. We don't subtract this amount from here and try and keep all of that together as one thing, because it begins to get a little bit complicated. It is easier to manage two calendar spreads than to look at all of this as if it's still one trade. In your mind, on paper, in your brokerage account, whatever you need to do, some brokerage accounts, some computer platforms for the brokers will let you add those short calls and then attach it to this so that this shows up as a spread, as a single individual spread in your account. And the same thing with this. Others might still try and hold this together as a straddle or strangle. Call your broker and see if they can separate them so that when you're looking at your open positions, if it's an easier view to see this as a trade and this is a trade. I'm really mucking up this screen, aren't I? Find a way to get your broker, or if you can keep track of it on paper, to look at these as two completely separate spread trades now, as though you opened them separate of each other, and manage them and adjust them going forward in that manner. Okay, so the same thing, same scenario, except this time maybe we started as a strangle instead of a straddle. We get that trend and we decide, because when we get this two tests of support or resistance and we're about 2 weeks past, we are sitting right there dead middle in between our two strike prices, and maybe that's all we need to decide, you know what, I am comfortable managing two completely separate trades, so I will go ahead and turn this into a horizontal call calendar spread, and I'll turn this into a horizontal. I've got that a little bit too high. It looks like it's a different strike price, but I'll turn this into a horizontal spread, and from that point in time, I will adjust and roll those positions as needed and manage them as two separate trades. When our stock price in a straddle or a strangle becomes stagnant, there are several things we can do. We can pick one side of the trade and add short options, creating a calendar spread, and sell to close the other side of the trade, hopefully for as little loss as possible. Remember, selling the other side of that trade brings a lot of money back into your trade. That alone lowers your cost basis quite a bit and makes it easier to manage the side you leave open. We could keep both long options open and short respective options against them, creating calendar spreads for both sides of the trade. Treat the call side of the trade and the put side of the trade as two completely different trades. And the reason I keep emphasizing this, act as though you opened two completely different trades in terms of how you then manage it going forward. Now, one thing I will tell you with straddles or strangles, give it that couple weeks past the date of the expected event. This is why you've got to open them with 90 days out to expiration. You need to be able to give it that couple of days past to make sure you feel some confidence in what's going on moving forward and you don't make a premature adjustment to it. Keep track of the cost basis and how it changes as we roll those short options moving forward. Odds are, once you create that calendar spread, you will make further adjustments beyond that. I would encourage you, after having viewed this class, whether you are with me watching it as I'm recording a new live one right now, or whether you're going through the pre-recorded streaming classes, even if it was just a week ago or a few days ago or earlier today that you watched the calendar spread and the adjusting the calendar spread class, it's worth going back and reviewing them, because the two, once you go into an adjustment, the two match up and are so similar. Folks, that wraps up adjusting straddles and strangles. We'll see you in the next live class if you're joining us live, or if you move on to the next recorded class, we'll see you there. Thanks, everyone. Bye-bye.